Okay, so what we're going to do now is just crack on and go straight into the CPI statistics excluding food and energy. And if you recall earlier, we looked at the CPI all items including food and energy. The code that we look for when we look for the CPI including food and energy is CPI AUCSL. When we look for the excluding food and energy number, so the CPI that excludes food and energy prices, we look for the CPIL FESL code. Now these numbers are actually released together on a monthly basis and they follow the same schedule. So following the schedule of the BLS, the Bureau of Labour Statistics, and you can go into the BLS website and check the schedule so you know exactly when they're released every month. The data for CPI X food and energy can be downloaded at the following link here. We'll be going into the link a little bit later when we go over to the spreadsheet. The data goes back as far as 1957, so not as far back as the CPI stats including food and energy, if you recall, which went back to 1947. The CPI X food and energy number is essentially calculated in exactly the same way as the CPI all items number including food and energy. However, the goods included in the overall basket don't include any food items and are not linked to the price of energy at all, including oil. The CPI X food and energy, which we're looking at now, you'll often see in the media referred to as the core CPI because it measures core inflation in the United States without having the exposure to international food and energy prices, which, as we saw earlier, can be extremely volatile and subject to exogenous influences in the global marketplace. However, we have to remember that even the CPI X food and energy is still a coincident indicator. It tells us what's happening in the economy now rather than in the future. So it's not as useful as the leading indicators because the CPI follows the leading indicators. However, it is still pretty useful to us because monetary authorities like the Fed, as we've seen on many occasions when analyzing our data, are reactionary, and therefore interest rate policy, money supply policy, all monetary levers are essentially based on inflationary expectations, and the way in which they behave will be affected by their expectations of the inflation numbers. So although it's a coincident indicator, you will see that in terms of inflation expectations, the Fed will react to these numbers. So although it's coincident, it's still an important number to appreciate. The way in which we analyze the CPI, X food and energy stats, is exactly the same way in which we analyze the CPI all items stats. We calculate a distribution of returns to discover what is normal and what is abnormal in order to scorecard inflation and deflation on our scale. We take the monthly rates and we work out percentage changes on a month-by-month basis, and we look at a trailing 12-month number to gauge inflation or deflation in the consumer prices X food and energy, comparing the number to the historical distribution of percentage changes. And we will also later on as well compare the CPI X food and energy to the CPI all items to see what key differences we can sort. Now we can go over to the spreadsheet and have a look at these stats. So why don't we do that now? So if we head over to the spreadsheet, endogenous driver analysis, we can start looking at the CPI X food and energy. So we want to come out of the tab here for the CPI that includes food and energy. First, we'll have a look at our sources tab. We go back to our inflation section and we find the CPI-L FESL, and we click on the link here. This takes us directly to the St. Louis Fed CPI, all urban consumers, all items less food and energy, usual format. Click on the download data button, open up the data. As you can see, it's all very straightforward, very quick. And you can see here, we just have two columns, our date and our CPI X food and items value. And we can scroll all the way down to our most recent numbers. Now you can click on the enable edit, and then you can start working on these numbers yourself and basically working out the distribution and fill up this whole area with your analysis. Now if we go back over to the endogenous driver analysis spreadsheet, and the one we want is the X food and energy, so CPI-L FESL, and you can see here we have our columns where we have a similar format, similar setup to earlier. We have our date going up in increments of months. We have our CPI X food and energy value. We have our percentage changes, and we have our real quarterly GDP stats on an annualized basis. So as you can see, we have a very similar setup in the CPI X food and energy as we do to the CPI including food and energy. We use same gates for our intervals, and then we have our table over here which is including our frequencies, so our occurrences and the percentage of times that these occurrences happen, with our cumulative distribution, our cumulative percentages, and our labels here for our ranges. We also have our overall average, and we also have our average positive case, average negative case, and our zero case, our frequencies, the percentage of times these happen, and our probability adjusted moves in the CPI X food and energy. We have our descriptive stats over here, and we have our analysis of the distribution relative to a normal distribution over here. We also have our scorecard, which we will come on to later, and further down, similar to the analysis earlier with CPI including food and energy, we look at the data pictorially. Firstly, we look at the data relative to real GDP, going back for the whole history, so all the way back to 1957. We have on the left-hand side, and in blue, the CPI excluding food and energy, and these are the monthly percentage changes. And then on the right-hand side, we have real GDP quarterly on an annualized basis, and that's in red. We also have our line of best fit, or basically our normal situation, which is our mean, our average across the entire data set for CPI fit to corresponding levels of GDP. We also then zoom in on the spreadsheet as we did earlier. We zoom in on the data and we look at the period from 2005 to 2015. So again, very similar to the analysis earlier, and you can go through this data, you can play with the data, go through the charts, and try to reverse engineer the spreadsheet again. It's just practice, do it on repetition, and get the processes down so you can do it on autopilot in the future. Again, also you can just add in the latest data on the bottom. So add in the latest row and you'll get an update here if you just include the updated row cells in your spreadsheets and also in all of your formulas to work everything out here. So let's go back to the presentation and start looking at these results for the CPI X food and energy. So again, what we're trying to do here is analyze the CPI X food and energy historically, so we can learn what the normal situation is. So learn what is normal and also what is outside the bounds of normality. And to do that, we take the same approach. We take a distribution of monthly percentage changes and discover what the behavioral nuances are of inflation or deflation when we exclude food and energy prices. And you can see straight away that there's a significant amount of positive data here relative to negative. In fact, on our scale, we can see no negatives whatsoever. There are negatives, but the size of the scale is such that we can't really see them on the chart. And when you analyze the data, the monthly increases, so inflation, X food and energy, outpaces the negatives by a factor of 77 to 1, which is huge. It's a huge difference, even when compared to the CPI including food and energy, which was a factor of 7 to 1. So let's go further into the stats. The long-term monthly average inflation rate, X food and energy, in the US is confirmed to be spot 306%. So we're looking at the average down here. The average inflationary month, so when we get positive data in a month, the average up month is 0.349%. The average deflationary month, so when we look at the negative data points, is 0.205%. When we multiply through by the frequencies, the probability adjusted monthly inflation rate is 0.3092%, and the probability adjusted deflation month is minus 0.0024% for deflation for down months. So you can start to see here and get an appreciation and understanding when we're thinking of this relative to CPI that includes food and energy. It's obviously quite different data. Okay, so let's continue to build this analysis out. Let's start looking at the standard deviations. So what we find is that one standard deviation of our entire sample from our descriptive stats comes in at 0.2539%. In the upper bound, when we have inflationary months, one standard deviation is 0.56%. And in the lower bound, so what we're supposed to be experiencing here is a deflationary situation. In the lower bound, it's actually positive. So it comes in at 0.053%. And 73% of months fall between these values when compared to a normal distribution. Now, what's interesting here is how different this is to a normal distribution, first of all, and also when compared to CPI including food and energy, because in the lower bound we had a minus number, and in the lower bound here we actually still get a positive number. So there's a massive skew in the data here towards positive occurrences. What we get to in terms of concluding in this distribution relative to a normal distribution is that essentially much more positive data similar to the CPI including food and energy prices, but also the distribution, so CPI X food and energy, inflation or deflation in the US the distribution relative to a normal distribution is peakier and has fewer but much larger tails versus a normal distribution. So it's actually very similar in that respect to the CPI, which includes food and energy. But this number here is obviously very different. In the lower bound, our one standard deviation move in a month is actually still positive, which is very surprising. It basically means that there's an incredible skew towards positive data in this data set. So again, we're starting to learn an awful lot about this data, not just when we look at it on a standalone basis, but also when we're comparing to a normal distribution and also comparing to its cousin, if you like, the CPI, including food and energy. Now, given that one standard deviation of the monthly CPI number X food and energy occurs 73.85% of times, and that it's 0.2539%, this basically means that around 27% of the time there's abnormal situations outside of this range, and they can be considered as shocks, so things that happen in the minority of cases. So these are including significant inflationary pressures and or significant deflationary pressures. However, in all cases, the inflationary pressures are going to outnumber deflation by a factor of 77 to 1, which is a huge skewness towards the upside, towards positive data. It's therefore now really, really obvious that inflation, ex food and energy, in its entirety is totally normal in the US and is totally required. So very similar in our analysis to CPI, including food and energy. The ex food and energy number, when we're learning about this number, what we're actually learning about is the wider capitalist system. If we exclude food and energy from CPI statistics, what we're seeing is that inflation is actually fairly predictable and absolutely necessary. It's also really obvious that ex food and energy stats differ a lot in their historical behavior to the CPI all item stats, so including food and energy. The difference is that CPI ex food and energy is much more stable, so less volatile and much more predictable. And this is the very reason why we look at CPI ex food and energy. It's to get an understanding of prices in the US by stripping out food and energy because they're susceptible to the global business cycle and supply and demand shocks that are outside of the control of US authorities. However, this doesn't mean that we shouldn't consider the CPI all items, including food and energy. Deflationary periods, whether the US likes it or not, clearly hurt the US, and the Fed must act as evidenced by history. Monthly deflation for CPI excluding food and energy occurs in about 11% of months. And I'm going to qualify that statement in a second, because if you look at the actual frequency of occurrences here, where you get negative numbers, the negative numbers are actually around 1%. However, the zero numbers add up to about 10%. So we can actually conclude here that if we get zero numbers in the CPI ex food and energy statistics, if we look at the zero numbers there, we can conclude that zero is as good as deflation, because the stats are so skewed towards positive values And if we point again towards that zero, the lower bound number coming in positive, that if we actually get a zero number, it's as good as deflation, because it's so normal to have some sort of positive number or some sort of inflation that to even get a zero value, we can consider it as deflation. So what we can do is filter our data to show values between 0 and minus 0.5% and just study the numbers. And if you look at the frequency analysis, there's 72 months in history, so 10% of months in which there is no inflation or there's a zero value. This isn't counted as deflation classically, as it's not a negative number. However, zero inflation can still be seen as deflation because inflation is so normal. On top of this, there's actually only 8 cases of negative numbers, i.e. proper deflation, in the CPI X food and energy numbers. And this occurs 1.1% of times. So when we look at these together, it comes to 11%, and we can consider this in its entirety as deflation in itself. Now, if we filter in Excel only for values equal to 0, we tend to find that 0 values are clustered around periods of GDP contraction. And we also find this with the 8 deflationary periods. So this kind of backs up the analysis of including 0 as a deflationary case. So we can take all of this information and begin to scorecard, as we have done in previous videos. The sliding scale has to really take into account that inflation is normal, and more normal when excluding food and energy than including it. So we're not going to score highly for normal rates of inflation and growth again. If there is inflation, we're going to have a short currency bias, but within the normal bounds, we're not going to assign a high score to what we consider as normal inflation on the CPI X food and energy. Now we're going to have a major short bias score in the currency when there is significant deflation, because history tells us that this only occurs in 11-12% of months, i.e. whenever monthly deflation occurs in the US, it's usually during periods of GDP contraction and the Fed acts. When deflation begins creeping and is small, we have to have a long currency bias, and when deflation is extreme, we have a short currency bias predicting inflation, because it's very apparent that the Fed will act sooner rather than later. The extreme inflationary pressures, so now on the positive side of the scale, tend to occur when there's significant growth in the economy, or at the end of cycles prior to slowdown, so deflation, or when the Fed aggressively acts to spur inflation in a crisis. This overall again adds fuel to our argument that in periods of severe deflation, we have to have a short currency bias in order to predict the inflationary move. Similar to M2 and also the CPI, including food and energy, we have to have a short currency bias on the extreme inflationary moves. Okay, so let's have a look at this pictorially again. So we're going to take the same approach as when we looked at the CPI all items including food and energy, and we're looking at correlating normal inflation with normal rates of growth. And because of this, when we discover what's normal in terms of inflation and what's normal in terms of real GDP growth, we're going to be assigning low bias scoring to normality. So as we can see pictorially from our chart that's available in the spreadsheet, we have our mean trend line, and the mean trend line occurs for CPI X food and energy around 0.4% and declines to around 0.3% over the entire data set. And this falls between values of 1.5 to 2.5% real GDP growth. So this is really considered to be normality here. And on extreme situations, we have in the red real GDP growth. Extreme situations, we have high levels of CPI X food and energy, around the 1% mark, which is equating to 6.5% real GDP growth. And in the negative extremes, the negative extremes are actually tighter and there's much less of them. So for example, minus 0.3% of CPI X food and energy is equating to around 2%, minus 2% real GDP growth. We can also zoom in on this and have a look at the period for 2005 to 2015. And we can see very, very few deflationary situations over this period where we're not including food and energy prices. So we can see, for example, in the financial crisis of 2007-8, that actually prices, X food and energy, stayed very stable. So that gives us an idea overall when we're looking in terms of macroeconomics, when we're looking at CPI stats, X food and energy versus including food and energy. The cyclicality of energy prices, if we compare to CPI including food and energy, obviously doesn't affect the X food and energy stats. And if you look back at the chart on the spreadsheet where we have energy prices, you'll see big moves down when we have big moves down in the cyclical oil price. What do we mean by cyclical? We mean that the price follows the business cycle. Now, the only negative move we have here is at the beginning of 2010, and lo and behold, just months later, what did we have? Quantitative easing. We had a quantitative easing program. So you can see and understand now how just small movements in CPI X food and energy that are negative have a huge impact on policy, or there could be a big connection between them. So let's move on to our scorecard and see how all of this works. So the format and makeup of our scorecard here when looking at CPI X food and energy should be looking fairly familiar to you in terms of how it's constructed. So what we have is a scorecard that's constructed in a very similar manner to many other within our systematic process, but also extremely similar, obviously, to the CPI, including food and energy. And you can see here that we're going up in increments of 0.2% on the inflationary side, and it's tighter on the deflationary side, going down in increments of 0.05% on the scorecard. And these numbers are again associated historically with certain levels of real GDP growth. And then we assign our scores as inflationary, deflationary, and in the zones of short and long bias. So we've seen what's normality during the benign to within the extremes, so the normal range, one standard deviation. We've got two areas. So when deflation occurs, we tend to have a long currency bias. And you can see here we have a zero value that is scored as a deflationary situation. And it's a minor deflationary score, so a minor long bias. This goes back to our analysis earlier when interpreting the numbers, that because inflation is so normal, ex food and energy, throughout history, that the abnormal situation of zero can be considered to be deflation. Now, slowdowns throughout history are usually occurrences of tighter monetary policy that overshoots, or due to a negative economic shock. So like the housing crisis we looked at earlier in 2008, and also in recent history, the terrorist attacks in 2001 and the stock market collapse in 2000. These situations here were negative economic shocks in which the oil price, when stripped out, saw inflation still go negative. So when we look at CPI X food and energy going negative, so these are the deflationary areas in recent history due to economic shocks, with the oil price not affecting the data. And future policy, if deflation gets out of control, is to loosen on the extreme moves. So for example, when we go out of the bound of minus 0.15% and we start to get to these numbers, it's pretty extreme in terms of deflation when compared to history. And we're starting to get indications of negative GDP of below minus 1%. These are the extreme cases in which we know that the Fed is going to act and do whatever it takes. So again, just note how this works on the scale. 0 gives us a deflationary reading and a long bias. We have a long bias with more conviction until we get to around here, and then we have to be prepared to flip around. We have to be prepared to predict action and predict inflation in the future and flip to a short currency bias. Now, when inflation occurs within the normal range, so when we're looking at the positive side, we tend to have a short currency bias. And throughout history, high growth is usually an occurrence of very normal or extremely loose monetary policy. The future policy, if inflation does get out of control, is to tighten and try to normalize after the extreme increases or during the extreme increases, unless of course there's a crisis. So when we're looking at the sliding scale going up here, we can see that we have what we looked at on the chart pictorially, the normal situation, so one standard deviation situation of inflation X food and energy at 0.2% with associated readings throughout history of 1.5% GDP and 0.4% with associated readings of 2.5% GDP. For the 0.2 scoring, we assign a 0, and for the 0.4 scoring, we assign a low conviction short bias. So we score a 4 here. So let's try to cement our understanding here in a lot more detail. The closer that we're going to get to extreme deflation, it's pretty obvious by looking at the data that the likelihood of future loosening monetary policy and the Fed being aggressive goes a lot higher. And the closer that we get to extreme inflation, the higher the likelihood of future tightening or normalizing, unless there's a crisis, of course. This is why we basically have a neutral bias, then a short bias all the way up the positive side of the CPI X food and energy scale. Because prices spend most of their time inflating, so 88% of the time inflating at a predictable and very normal rate of around spot 3% per month, which is why we score a short bias very low on the scale. And we're going to introduce a term here now, which you may not be familiar with. We're introducing the term zeroflation. So when we have 0 in CPI X food and energy, we basically consider this as deflation. So deflation or zeroflation occurs 12% of the time. And in these situations, it's more likely that the Fed is reacting to overheating in order to deflate. Now, this is not a common occurrence, which is why we score higher for a long currency bias in deflationary periods versus a short currency bias during inflationary periods. So you can see the magnitude of the numbers here in the deflationary zone. The magnitude of the numbers goes up very, very quickly in a very tight range. So you can see we have extreme scores for deflation in the negative. Now, one interesting point is if you count the scorecard occurrences, there's 15 in total. 10 are inflationary, so short currency bias. 4 are deflationary, long currency bias, and 1 is neutral. And when you look at the scores for short currency bias, they're slightly more extreme when you add them all up. So when we add up these and these, we have more extreme situations overall than extreme situations in the deflationary zone. Throughout history, what you will see in the United States is stimulus when economic crises occur. And this is obviously designed to counter deflationary conditions by the Fed by causing inflationary pressures. The more deflation that occurs on our sliding scale, we end up having more conviction that it will be dealt with by the authorities. So as with everything on our sliding scale, we have to be prepared to jump and change our mind when things get really nasty, get really out of control. In the opposite, when we look at the positive side, we have a fall in conviction when significant inflationary pressures occur. So when we start getting to the extreme outside within normal bounds, outside our normal bounds, when we get to extreme numbers, we fall in conviction. That's because when inflation gets out of control, it's more than likely that future policy will be to tighten. So we may actually be entering a deflationary period, and we must be prepared in our conviction to switch from a short currency bias here to a long currency bias potentially here, or even to neutralize, to be flat in our bias. So we should be getting a general grounding here, a good grounding, a thorough understanding now of how the scorecard system works, and in the broader sense, how we analyze macroeconomic numbers as part of an overall systematic process, how we interpret those numbers, and how we scorecard them as inputs and drivers to the overall systematic analysis, with the intention of being objective and obtaining a bias on the value of the currency. Now, what we can do is we can start comparing the CPI X food and energy numbers with the CPI all items, so including food and energy numbers. And what we find is on our scorecards, when we compare them, that the X food and energy scorecard is more extreme or higher in magnitude in the deflationary or negative zone. So when deflation occurs, we can see that the numbers here are higher in magnitude than the numbers here when we look at the scorecard for CPI all items, including food and energy. And we can also note that at the zero bound, at zero values, we even consider this deflation as well. We can also see that the numbers are slightly more extreme here in the extreme case. So when we have a short bias towards the currency, because we're going to predict inflation as a result of central authority action. So we have a slightly higher magnitude short currency bias in the deflationary zone here. And that's because when we strip out food and energy and look at the core CPI, deflation is a much, much rarer occurrence. So it means we can have more conviction that when the CPI core stats are 0 or negative, that our view is going to be right. So when we have a 0 or slightly negative number, we basically are saying that the currency in the short term is going to increase in value because prices are going lower, deflationary. But if this gets out of control, we have a very high conviction, even relative to the CPI. We have a very high conviction that the authorities, the central authorities, are going to react and spur inflation in some way. So we predict inflation and we have a short bias. So the scorecards work in exactly the same way in terms of systematically scoring all CPI, but slightly different and tweaked in the way we scorecard for CPI ex food and energy relative to CPI all items, including food and energy. So now let's conclude on CPI ex food and energy and see what type of score we can assign to the current situation. Well, if we take a very similar approach to CPI all items including food and energy, we take the last 12 months and we continue to do this on a rolling basis. So when you get new numbers coming out each month, you just take the last 12 months by inserting it in the latest row and including this in your overall statistical analysis, and take the last 12 months. So if we put in a new row here, we would have 13 rows in this data set, and then we just exclude the top one. If we take the last 12 months and then work out an average, we get the average monthly price change of the CPI ex food and energy of the last 12 months. And this comes in at spot 135.828%. And you'll notice that we're looking at a lot of decimal places here. We're not doing that by accident. It's because the numbers are incrementally very, very small month to month. So we want to be a lot more accurate in our analysis when looking at ex food and energy. So we can see and conclude from these numbers that the last 12 months we've had very stable core CPI. And what that's going to do, if we read across onto our scorecard, is put us within the normal range. So it's going to put us around here. And it's going to give us a 0 to even a maybe even slightly deflationary number. So it depends how conservative we want to be in terms of scoring it, but we can assign it either a score of 0, a score of -4, or somewhere in between. But overall, when we consider the CPI all items, which gave us a -6 score, and CPI ex food and energy, which gave us around a 0 score, the US right now, when we only look at CPI, is experiencing a deflationary situation. Now, in the CPI all items, we can obviously read across here very easily and put this down to oil prices, because in the last 6-7 months, oil prices have come down by 50%. And in the CPI number, including food and energy, we do still have inflation, but we should be very concerned because it's actually in the bounds of normality, but it's much lower than the one standard deviation move in a month, which is around 0.25%. And we know from our very rare occurrences that if CPI X food and energy goes negative, this is only in 1% of times. And if it goes to zero, this is in 12% of times, so zero or negative. So we have to be a bit careful here. We're going to scorecard around a zero, or depending on how conservative you are, you could scorecard a -4 or anywhere between a 0 and -4. So the message here is, regardless of how the CPI X food and energy is perceived by the market, or how the CPI including food and energy is perceived by the market and the differences between them, the US is experiencing deflation in their CPI numbers. And we're going to scorecard accordingly and be very objective in our systematic approach. And overall, we'll see later what we come out with when we look at all drivers together. But we have to go through each one and do it very objectively. Okay, so let's go back over to the trading desk and we'll have a wrap up on CPI, and then we'll move on to the producer price index, PPI. Okay, so welcome back to the desk. We decided to go straight through the CPI before we came back to the desk and conclude on everything, because I think it's important in the lessons that we learn here, not just about overall inflation, but also about consumer inflation when comparing including food and energy to excluding food and energy. So what do we learn overall about inflation then? Well, the first thing we learned is that inflation is actually just totally normal, and we should always expect inflation. In fact, in the US, the Fed has inflation targets like many other Western capitalist economies, and those inflation targets are set as one of the most important economic indicators for the economy to reach every year and every quarter. It's a very, very important indicator in that sense, because the authorities are setting the targets and they want those targets to be met, and they place very, very high importance on that. And that's because a level of inflation that's predictable and stable is extremely important to an overall healthy economy for predicting growth. So inflation is completely normal, and therefore when we have abnormal or abnormalities in inflation, these become of even more significance. Now, the other thing that we learned is that in the CPI, including food and energy is very, very different actually in its behaviors to the CPI excluding food and energy. And historically, when we analyze the data, that really comes down to the oil price. When you look through the data, there's a very, very high correlation between abnormal CPI, including food and energy, with very high oil prices and oil prices falling very aggressively. So CPI, food and energy, including food and energy, is a lot more volatile and cyclical when compared to CPI X food and energy. And when we have these big moves in oil, what actually happens is it can actually swing the dial on our sliding scale as to whether we have a short or a long currency bias. So moves in oil are very important actually for CPI in the United States, and that's something definitely to take note of. Now, because of that, when we actually strip out food and energy prices to the CPI, we end up with a core CPI, So a CPI number that doesn't include any shocks from the oil price. Now that just means that if the CPI ex food and energy is moving in a volatile way and it's knocked down to food and energy prices, then this creates an even more significant inflationary abnormality. So this is something we obviously have to watch out for, because that can give us big swings in our bias towards the US dollar. So very important to understand how inflation works and going through the numbers and understanding the dynamics. Now we're going to apply the same dynamics to PPI and see what we can learn there. See if we can learn as much about the PPI as the CPI. So let's go over to the next video and we'll start looking into PPI.